debt funds have become an attractive asset class given the higher yield amid rising interest rates. Now, central banks around the world, including in India, are raising interest rates to rein in inflation. So, with the interest rates expected to near their peaks this year, does it make sense to go overweight on debt? And what are the funds or categories in the debt space that you as an investor should be looking at while investing? And to answer all these questions, we have on board Feroze Azeez, who is the Deputy CEO of Anand Rathi Private Wealth Management. A very good evening, Feroze. Thank you so much for joining us today on ET Now. Whenever we talk and look for some of the asset class investment, which is risk free, just two names pop up. Firstly is FDs, and the other one that we have is debt mutual fund investing. With the kind of scenarios around us, with interest rates on the rise, inflation on the rise, just want to know your understanding. Like, now is the time when we can say that debt fund category has become more lucrative than FDs.
Yes, absolutely. Debt fund as a category is a very lucrative category for sure, especially given the kind of contemporary situation we've seen over the last 6 8 months, both inflationary pressures resulting in interest rate hikes, and also the fact that there is tax arbitrage in India when you invest through a debt mutual funds. Their attractiveness for a person in the highest tax bracket is very, very high. But coming to the other comment which you made, like interest rates have almost peaked out, I completely concur with that specific statement. Because if the globe, 40 50% of the globe is going to slip into a recession, the only lever, the largest used lever in the past when it comes to recessions is bringing down interest rates. And that's going to happen in the second half of this year. And I think especially when inflation comes back into control. So we are in the near peak kind of zones. The third point, very critical, is I think people do overthinking on debt investing. And simplification is the need of the hour. When you go to make a fixed deposit, you're not going to see, will I get 0.25% more the next month? And you go back next month to make the fixed deposit. But when it comes to debt fund, people want to time interest rate cycles, especially when it is not needed, when you can have a low cost strategy giving you 6.5% post tax. Lending to government of India, what's the point timing it at the peak of the rise cycles? I've seen several fund managers also saying, wait for a couple of months, you'll get 10 paisa more, 20 bips more. That's okay for a bank's treasury. For a person who's going to put 10 lakh rupees, for 5,000 and 10,000 rupees, he timing that doesn't make any sense to my mind.
Totally get your point, Feroze, out there. But when we talk about the options that are available in debt mutual fund investing, so keeping so many scenarios in view, what will be your advice in terms of the time horizon of investing and which category particularly to go forward for 2023?
I think debt as an investment, you go only heavyweight for goals which are below 5 years. I personally think anything above that, equity is going to be beating debt hands down, given the situation where India is in. So if you're going to get twice more than debt funds over a 5 year period, should you overly skew your investments for periods which are greater than 5 years into debt? The answer is no. Coming back to which category which you should look for, I personally think you have to simplify your life. Just go for target maturity funds which invest in central government paper, which are low cost. As long as you can take care of these three things, uh, central government paper, least cost possible, and a target maturity fund where the fund managers doesn't do any management. If you are going to get an implied FD rate of close to 10%, if you are in the highest tax bracket, if you take an FD of 10%, you will end up paying 3.5% as your tax and you will be left with 6.5. Today, that's what you end up getting if you buy a 3 year plus target maturity fund only lending to central government, where the probability of default is negligible. So, coming back to your question, you have to keep your life simple, ignore most of the categories, just focus on a target maturity fund of central government. Everything else, even a state government paper, gives you only a 0.2% more, not worth the complexity.
But does it make a case at this point in time to consider the roll down strategy?
Yes, a roll down strategy is one of the nomenclatures which is used for specific kinds of funds A roll down strategy, if I have to articulate it for the benefit of the viewer, is buying a fund manager buys the bond, does not do any management, waits for it to roll down till it becomes a matured bond. That's why it's called a roll down strategy. So if you buy a 3 year roll down fund, after 1 year, the bond will be just 2 years to maturity. So you're marrying your objective of holding period with a fund manager's objective of holding period. So that makes minimal management and in turn low cost possible.
Okay, Feroz. So finally, let me ask you this question that keeping so many scenarios in view and also where you have already shared your preference when it comes to the debt mutual fund investing, is this a time to go overweight on the debt category?
Yes, to my mind, yes. It also this question has two parts. Where do you exit from and where do you go? If it is an FD exit, I would say you should make FDs zero. Unless you have an affinity towards a bank, there is no reason any highest tax bracket individual should have even 1 rupee in a fixed deposit. Because a bank can still default, but central government can't default on a rupee bond. So you're reducing risk, increasing return by 50%. See, if you take a 7% FD, you get 4.5% after tax or 4% after tax. Here you will get 6.5% after tax. That means if you're getting an interest of 100 rupees after tax, now you will get 150 rupees after tax. So to answer your question, if the money is coming out of fixed deposit, you should go completely overweight debt funds and zero in fixed deposit if you're at the highest tax. If the money is coming out of equity, you have to ask yourself this question: is this money needed for the next 4 5 years? If the answer comes yes, I will need the money at the end of third year, second year, fourth year, you can definitely go a little overweight debt and reduce your volatility, not at a huge cost of reduction in return.
Okay, but Feroz, you also make life simpler in terms of bifurcating your investment in terms of equity and debt. You have already answered a part of that, but the next question that I have for you is that given the kind of different maturities for this debt fund category, you have already shared that anything below 5 years is what is preferred. But still, if somebody has to make bifurcation between different time horizons and between equity and debt, what will that investment portfolio be looking like?
See, for 5 year plus goals, if you have even 80% in equity and 20% in debt, your expected return, with a lot of statistics involved, expected return, not a certain return, could be 12.4%. And the risk or the standard deviation, which is a measure of very robust measure of risk, is 10.7%. That means if you're expecting 12.4, there could be swing in the return by 10% up or down. So that's one standard deviation range. If it's medium term, 3 to 5 years, look for at least 70% in equity, 30% in debt. You will still have double digit returns of 11, 12% possible. Why is this important? It's important because when you look at high inflationary periods, you have to also protect the power of your money. Your responsibility is not just to protect its optical value, you have to protect its depleted value due to high inflation. So for which you will at least need 70-80% in equity. So that will be the recommendation if you look at both asset allocation. But when it comes to allocating between debt funds and different periods of it, today even the 1 year paper or 1 year bond of Government of India is giving you 6.5. A 10-year paper of Government of India approximately is giving you 7.3. So the remuneration available for a 9 more year lock-in is not adequate enough. This is called a flattish kind of a yield curve. So even if you locked in for anything above 2 to 5 years, your debt investments in a target maturity fund, that's a wise thing to do in my opinion.